Greetings, my beloved clients and friends. I want to talk to you today about a trade that I placed recently. And before I start, let me say this. This is not investment advice. I only give investment advice to people that pay me for it, and only after I have taken the time to understand their current financial situation. Okay, so that being said, I want to talk to you about a trade we placed recently. And another thing, we don't normally do much trading. We mostly do investing. And there's a big difference. Investing is long-term, looking at great companies that you can hold for a long time. Trading is more a short-term, opportunistic, and it's also more risky. So we don't do a lot of it, but occasionally the opportunity comes up where the reward maybe justifies the risk, and we take some trade, and we'll do a trade every now and then. So the trade we placed was Bed Bath & Beyond. We've been buying that, building a position over the last couple weeks, and I want to tell you the reason why. The big reason was that Ryan Cohen acquired a 10% interest in the company. Now, you might remember Ryan Cohen was the guy behind the Gamestop frenzy last year, and which the reason we had bought Gamestop was the same reason. We saw Ryan Cohen had bought a 10% interest. And you'll see as we talk about it that the two scenarios have a lot of similarities. Okay, it's basically the same playbook over again. So Ryan Cohen, back in end of August of 2020, he had acquired a 10% position in GameStop, and I had seen GameStop go up. It had been around a $5 stock, then all of a sudden it was $7-8 almost overnight. I was like, what's going on with that company? That's a huge run. And I was familiar with the company, so I investigated, and the news said that Ryan Cohen had bought a 10% interest, and I had not heard of this guy. Who is Ryan Cohen? So I did some research, and I found out that he had been the founder of Chewy, which was an online retailer of pet products. Okay, and he had done a great job with it. He sold it to PetSmart, and it had gone public, and it had done phenomenally. And the guy was really sharp in terms of online retailing. He understood the space. So with the money that he made from the sale of Chewy, he took a portion of that, a small portion, and he acquired an interest in GameStop. And it was his first foray into 13D activist investing. And so I'll give you a little bit of the history. So on August 31, he reported that he had acquired a 10% interest in the company at an average price of $5.98. And then early in September, the stock market started reacting to that. And it popped on that news. 11 weeks later, he sent a letter to the board of directors saying, it was a scathing letter, critiquing the board of directors for their mismanagement and suggestions of what they should be doing. But I want you to notice that it was 11 weeks later. He first tried to speak to them privately and informally, and it went nowhere. So 11 weeks later, he sends out a letter, and that was on November 16th, 2020. 8 weeks later, on January 11th of 2021, GameStop gave Ryan Cohen 3 board seats. So they said, okay, we're going to listen to you. We're going to give you influence over the company, and let's see what happens. That's when the stock really started taking off. So it went basically from 5 to 10 on news that he had acquired the company, and about 10 to 20 on news that he was formally pursuing making some changes as an active investor, as evidenced by the open letter that he sent. And then when he got the 3 board seats, that's when it really took off. And 3 weeks after that, that's when the stock peaked at like $483. So that was the big move, right? 5 to 10 on the news that he had taken a 10% position, 10 to 20 on that he was actively pursuing activist action, and then 20 to 483 when he had gotten the 3 board seats. Okay, and so that was over the course of 5 months that happened. Okay, and we'll talk about some of the other situations. And here are some of the key characteristics of that GameStop trade. Let's go there. So number one, it was a brick and mortar retailer that had been struggling in the face of an industry transitioning to online. Okay, and remember, Ryan Cohen's strength was online retail. And the stock was in a multi-year downward trend. We're talking about GameStop now. It had hit a high of over $57 in 2013, and by 2020 it had traded as low as $257. So it was like over 90% decline from its peak. Okay. And it was trading at a fraction of its sales. Price to sales was at 0.11. So it was trading very cheap, not only from its highs, but relative to its sales as well. And it had a pretty small market cap at that levels that he started buying at $690 million. It was a sub $1 billion company at that time. And there was a lot of short interest. The percent of float in GameStop at the time, the short percentage float was over 100%. So there was a lot of short interest behind this company. Sales had been flat to down for the past 5 years, so it's kind of languishing. There was a new CEO struggling with a turnaround strategy, and they had a bond coming due shortly. And it was very uncertain whether they would be able to pay that bond off. I think it was coming due in March of 2021. And so that's why the shorts, the vultures were basically, circling around GameStop. It was super cheap, and they were prepared for it to go to zero, not prepared for it to bounce up. Okay. So let's compare that scenario to the Bed Bath & Beyond scenario that we're looking at today. Okay, so on March 6th, it's a few weeks ago, Ryan Cohen acquired a 10% stake in Bed Bath & Beyond. He announced that he acquired a 10% stake in Bed Bath & Beyond. That same day, he sent a letter to the board of directors. Again, a scathing letter, what they'd been doing wrong and what they need to be doing. Notice that he did not wait 11 weeks. This is his second. Now he's an experienced active investor, right? This is his second run at it. He said, I'm not going to waste my time with these informal talks. I'm just going to send a letter right away. So this one seems to be happening a lot quicker. 3 weeks later, on March 25th, that's earlier this week, the board of Bed Bath & Beyond announced they were going to give Ryan Cohen 3 board seats. You see how not only Ryan Cohen is moving a lot quicker, but the board is moving a lot quicker. Okay. Now the stock has yet to pop. He started buying his average price when he was buying Bed Bath & Beyond was 15. When the news came out the next day, March 7th, the stock shot up to 30. That was the intraday high, but it ended in the low 20s. And right now it's still in the low 20s, in the $22 range. Okay, so the stock really has not yet popped yet on the news. Not dramatic, a little bit from 16 to the low 20s, which is about a 30% pop, 30 to 40% pop, but not the huge pop. And that's on the news that Ryan Cohen acquired 10% stake. He sent a letter and he got his 3 board seats. So I believe it still has a lot of room to go up from here. Now notice the characteristics of Bed Bath & Beyond that are similar to Gamestop. It's a brick and mortar retailer that had been struggling in the face of an industry transition to online. That's word for word, right? And they had, like GameStop, they had some desirable assets. The stock price is in a multi-year downward trend, just like GameStop. From a high of from a high of 80 in 2013 down as low as $3 in 2020. So notice the difference. It's dropped even more dramatically, but the bottom was in 2020 and we're already in 2022, so it's off that bottom from 3, now it's at 20. So it's off that bottom quite a bit. So we're not buying it as cheap. Okay, so that's going to limit our upside a little bit. Number 3, it's trading at a fraction to sales. So not only is the stock price off its high, but it seems cheap relative to sales. It's trading at 0.28 times sales. But it has historically traded, over the last 3-4 years, kind of cheap relative to sales. Okay. It has a market cap of $2 billion. So it's a bigger market cap company than GameStop was at the time when this opportunity presented itself. So that also limits the upside a little bit. It's easier to move a small company, have a dramatic price increase than a bigger one. Okay, it's about 3 times the size. But it does have a high percent of float, short percent of float. The short percent of float on Bed Bath & Beyond is 67%. So there is a lot of short interest in Bed Bath & Beyond, which is good. Sales had been flat to down in the previous 5 years, same as GameStop. And there was a new CEO struggling with a turnaround strategy. Okay, so there's a lot of similarities, a ton of similarities. We're not buying it as cheap, so it doesn't have as much upside. And we don't have that big looming bond maturity. They're not in as dire straits as GameStop was. But you'll see that Ryan Cohen, he knows what he likes, right? It's his type. And I believe one of the things he said about Bed Bath & Beyond was that they own BBBY, and he said that company alone is worth more than the entire market cap of Bed Bath & Beyond. And it's, I think, about 25% of sales. So he says first thing we should do is unlock the value of BBBY. Okay, so I think that news like that would give the stock a pretty big pop. And the 3 people that Ryan Cohen selected to be on the board, added to the board of Bed Bath & Beyond, are all experienced investors in corporate finance, in how to take a company public or to sell off assets and that type of thing. So they're preparing for that. The other thing Ryan Cohen did this time around that he did not do with GameStop was he hired a proxy solicitation company, the same one that Carl Icahn uses. So he's ready for a proxy fight. So if we still own Bed Bath & Beyond and it comes time to voting of the shares, that's one that we're probably going to want to take a close interest in. So the table is set, and I think Bed Bath & Beyond could run up from a market cap of $2 billion easily into the 6 to 10 billion range, which would be a 3 to 5x return on the stock. Now, when Ryan Cohen has a big following on the internet, they call him Papa Cohen, and these were the people that ran up the price of GameStop way beyond what it was really worth. And so, I mean, if they get behind Bed Bath & Beyond, one, with the opportunities to unlock value, two, with the the short sellers now exposed to a company that has the ability to rise quite a bit, and three, if the what do you want to call them, the Reddit rebellion or whatever you want to call them, they get behind this, it could go up quite a bit. Now, one thing to note, at its very peak, GameStop was able to get to about 30 billion in market capitalization. That's when it was that was when it had hit its peak of $483 a share. But it was not able to sustain that more than a minute. They had a hard time getting it to 30 billion in market cap. I'm talking about the traders, right? With all their hype on the internet and Reddit and stuff like that, they were not able to sustain a $30 billion valuation. And the fact that they were able to run it up beyond 20 billion was impressive. And that was a $300 price. Okay, so keep that in mind if you're kind of trying to calculate the upside on this Bed Bath & Beyond. Interestingly, those traders got behind AMC, and they also ran that up. And guess how high they were able to run it up? 30 billion in market cap, and they were not able to sustain that. It dropped back down from that. So you need a company with a small market cap, a small float, to be able to, and kind of light trading volume, to be able to run it up dramatically. And even in the perfect situation, it's hard to get it up past 30 billion. So, I mean, if everything went right in a fantasy, I mean, the most you could expect in your dreams is this thing to hit $300. That would be about a 30 billion valuation. And I don't expect that. It was too perfect a scenario for GameStop. I don't think that'll ever happen again. The element of surprise is gone. So don't expect it to go to past that. But I think I could see a scenario where it goes, right now it's in the low 20s to $60 a share, which would be a $6 billion valuation, which would be still less than one-time sales, to $100 a share, which would be a $10 billion valuation, which would be just over one-time sales, and maybe a little bit higher than that if a speculative frenzy takes hold of it, or a short squeeze. But that's what we're looking at. So I think it's a pretty decent opportunity, nowhere near the opportunity of GameStop. And so to think about what was going on in January of 2021 when the GameStop thing happened. Well, one, we were in the middle of, smack dab in the middle of the COVID outbreak. It was the third wave. It was winter time, right after Christmas and New Year's get-togethers, and the COVID was peaking in that time. So people had to be home. The government was still sending a lot of money, unemployment checks. So people were at home. They had money. They had nothing to do. And there was a really risk-on environment in the market. Risk was on. Interest rates were very low. So it was kind of that perfect storm. But politically, January 6th was the day of the insurrection on Capitol Hill. Biden was inaugurated end of January, so there was a kind of this changing of the guard, and oftentimes, any type of change in either direction, there's a little bit of wave of optimism, So that was the scenario of January. And what's the scenario today? Well, the market is much more in a risk-off environment. Interest rates have come up. COVID, at least in the United States, there's not that massive fear like there was in January. And the vaccine is out. People have been vaccinated, and people are out and about, not wearing masks, and so they're not locked up in their room looking at their computer. And the checks aren't flowing like they were back then. So, and there's a war in Ukraine, So maybe there's not that much attention and not that much money or, kindling to really fuel this fire like there was last time. So we're tempering our expectations because of all those scenarios, but we still see it as a pretty interesting opportunity that we're going to keep a close eye on. And it's just textbook activist investor. When I read the letter I wrote about GameStop, I could practically write the exact same letter word for word without only replacing GameStop with Bed Bath & Beyond. Let me read a paragraph. The company had management problems. They were holding doggedly to a brick and mortar retail strategy. The stock had tumbled from a high in 2013 down to a low in 2020. Market sentiment the company was on the verge of bankruptcy. I don't know about on the verge of bankruptcy for Bed Bath & Beyond, but market sentiment is not real good. It represented a textbook definition of a typical activist target. They looked like the ideal candidate for an activist investor to come in, buy a large stake of the company, shake up the board, and realize a handsome profit in a short period. Here is a quote from my CFA textbook. Target companies feature slower revenue and earnings growth than the market, check. Suffer negative share price momentum, check. Have a weaker than average corporate governance, check. Traditionally, the target companies have been small and medium-sized listed stock, check. So they check all the boxes for a typical activist target. And Ryan Cohen got what he wanted really quickly. In 3 weeks, he got his 3 board seats. So now let's see what happens. We expect to probably maybe hear some news on what the company's going to do with Bye Bye Baby, if they're going to sell it off, if they're going to concentrate or redirect their corporate strategy. All these things would be interesting news. And if it pops quickly, then the shorts are in trouble, and then that exacerbates the buying pressure. And if Ryan Cohen's followers, they call him Papa Cohen, they get behind that, it could exacerbate the buying pressure as well. So we'll keep an eye on this, and once again, it's a trade and it should be interesting. Okay, have a great day.